Are you wondering how to make your money work harder for you in 2025? It's a question a lot of us are asking, especially when it feels like just saving cash isn't enough anymore. You hear about stocks, property, crypto, and all these different ways people are supposedly making a killing, but honestly it can be overwhelming. From stocks and property to crypto and smart savings, there are more ways than ever to invest. But how do you know which strategy fits your goals, your risk tolerance, and your lifestyle? It's not just about picking what's popular, it's about picking what's right for you and your financial future, and that's a big decision. In this video, we're breaking down 10 powerful ways to invest your money, with the key pros, cons, and examples you need to know. I'm going to walk you through each one, step by step, no confusing jargon, just the straight facts on what to expect. We'll cover everything from the classic tried and true methods to some of the newer, more modern approaches. Whether you're building towards retirement, saving for a home, or just want to grow your wealth and finally get ahead, there's something here for you. My goal is to give you the clarity you need to move forward. So let's dive into the world of investment and help you choose with confidence. Make sure you grab a coffee, get comfortable, and maybe even take some notes, because by the end of this video, you'll have a much clearer picture of where you can put your money to work. We're going to demystify this whole process so you can start making informed decisions that will pay off in the long run. Let's get into it. All right, first up, let's talk about the big one, investing in stocks, or as some people call them, shares or equities. When you buy a stock, you're literally buying a tiny piece of ownership in a public company. Think Apple, Amazon, or Tesla. If that company does well, makes a profit, and grows, the value of your share should, in theory, go up. This is how people like Warren Buffett have built incredible wealth over time. The potential for high returns is the main attraction here. Over the long term, the stock market has historically outperformed almost every other type of investment. The pros are pretty clear. High growth potential and liquidity, meaning you can usually sell your stocks and get your cash back relatively quickly on any business day. Plus, some companies pay out dividends, which is like a small cash reward just for being a shareholder. You can reinvest those dividends to buy even more shares, and that's where the magic of compounding really kicks in. It's a powerful way to accelerate your wealth building, as your money starts to make money all on its own. Now for the cons, and this is important, volatility. The stock market can be a roller coaster. Prices can swing wildly based on news, economic data, or even just investor sentiment. You could see the value of your investment drop significantly in a short period. This is why it's generally considered a long-term game. If you panic sell when the market is down, you lock in your losses. It requires a certain amount of emotional discipline to ride out the downturns and trust in your long-term strategy. Let's look at a real-world example. Imagine you invested $1,000 in Microsoft back in 2014. By 2024, that $1,000 could have grown to over $10,000. That's the power of picking a solid company and holding on. But for every Microsoft, there are other companies that don't perform as well or even go out of business. This brings us to a crucial tip: diversification. Don't put all your money into a single stock, no matter how much you believe in the company. Spreading your investment across 15 to 20 different companies in various industries like tech, healthcare, and consumer goods is a fundamental way to manage risk. If one of your stocks performs poorly, it won't wipe out your entire portfolio, because hopefully the others will be doing well. This is the cornerstone of smart stock investing. You're not trying to hit a home run with every single pick. You're trying to build a solid team that, on average, wins the game over time. Next on our list is bond investing. If stocks are the flashy, high-scoring strikers on your investment team, think of bonds as the reliable defenders. When you buy a bond, you're essentially lending money to an entity, which could be a corporation or a government, like treasury bonds. In return for your loan, they promise to pay you periodic interest payments, often called coupon payments, over a set term. At the end of that term, when the bond matures, you get your original investment, the principal, back. The biggest pro of bonds is their stability and predictability. They are generally considered much lower risk than stocks. The fixed interest payments provide a steady, predictable stream of income, which can be fantastic if you're retired or just want a more conservative element in your portfolio. Government bonds, especially those from stable countries like the United States, are seen as one of the safest investments you can make because the government is highly unlikely to default on its debt. However, that safety comes at a cost, and that's the main lower returns. You're not going to see the explosive growth with bonds that you might see with stocks. Your returns are pretty much capped at the interest rate you agreed to. Another risk is inflation. If the rate of inflation is higher than the interest rate on your bond, you're actually losing purchasing power over time. Your money is growing, but the cost of living is growing even faster. There's also interest rate risk. If rates rise, newly issued bonds will pay more, making your older, lower rate bond less valuable if you try to sell it before maturity. For a real-world example, let's say you buy a 10-year US Treasury bond for $1,000 with a 4% annual interest rate. Each year for 10 years, you would receive $40 in interest payments. After the 10 years are up, the government gives you your original $1,000 back. So in total, you've received $400 in interest, plus your initial investment back. It's not a get-rich-quick scheme, but it's a very reliable way to preserve your capital and earn a modest return. Bonds play a crucial role in a diversified portfolio by providing a cushion. When the stock market is volatile and falling, bond prices often remain stable or can even go up as investors flock to safer assets. This balancing act is why many financial advisors recommend a mix of stocks and bonds. The exact ratio depends on your age and risk tolerance, but having that steady defensive player on your team can give you a lot of peace of mind during turbulent times. Let's move on to an investment. You can literally touch real estate. This is a personal favorite of mine, as you guys know. The most common way to invest is by buying a physical property, like a house or an apartment, and renting it out. This can create a steady stream of passive income through monthly rent checks. On top of that, you have the potential for appreciation, where the value of the property itself increases over time. It's a tangible asset that isn't tied directly to the daily swings of the stock market. The pros are significant. You get cash flow from rent, your property value can appreciate, and there are some serious tax advantages. You can often deduct expenses like mortgage interest, property taxes, maintenance, and even depreciation, which can lower your taxable income. Plus, you have leverage. You can buy a $400,000 property with a down payment of just $80,000, for example. If that property's value goes up by 5%, your asset is now worth $420,000. That $20,000 gain on your initial $80,000 investment is a 25% return, which is incredibly powerful. Of course, it's not all passive income and sunshine. The cons are very real. Real estate is illiquid. You can't just sell a house in 5 minutes like you can with a stock. It can take months. It's also management intensive. You're a landlord, which means dealing with tenants, toilets, and termites. Repairs can be expensive and unexpected, and there are high entry costs. You need a significant amount of cash for a down payment and closing costs, which makes it inaccessible for many beginners. As a real-world example, imagine you buy a single-family home for $300,000. You put 20% down, which is $60,000, and get a mortgage for the rest. You rent it out for $2,200 a month. After paying your mortgage, taxes, insurance, and setting aside money for repairs, let's say that all adds up to $1,800 a month, you're left with $400 in positive cash flow each month. That's $4,800 a year, while your tenant is paying down your mortgage and the property is hopefully appreciating in value. That's how you build wealth with real estate. But what if you don't have $60,000 for a down payment or don't want the hassle of being a landlord? There's a great alternative. Real estate investment trusts, or REITs. These are companies that own and operate income-producing real estate. you can buy shares in a REIT on the stock market, just like any other stock. This gives you exposure to the real estate market and often pays high dividends, but without the need for a huge down payment or landlord duties. It's a fantastic way to get your feet wet in real estate investing. All right, let's talk about one of the most popular investment vehicles out there today, especially for beginners: exchange-traded funds, or ETFs. Think of an ETF as a basket that holds a whole bunch of different investments, like stocks, bonds, or commodities. When you buy one share of an ETF, you're instantly buying a small piece of everything inside that basket. For example, an S&P 500 ETF holds shares in the 500 largest companies in the United States. The number one pro of ETFs is instant diversification. With a single purchase, you can own a slice of hundreds or even thousands of companies. This dramatically reduces the risk that comes with picking individual stocks. If one company in the ETF performs poorly, it has a very small impact on the overall value of your investment. They are also incredibly low cost. The fees you pay, known as the expense ratio, are typically a tiny fraction of a percent, meaning more of your money stays invested and working for you. Another huge benefit is that they trade on the stock exchange, just like individual stocks. This means you can buy and sell them throughout the day at a known price, offering great flexibility and liquidity. This is a key difference from their cousin, the mutual fund, which we'll get to next. The transparency is also a plus. You can typically see exactly which assets an ETF holds at any given time, so you know what you're investing in. So, what are the cons? Well, because ETFs are so easy to trade, some investors are tempted to buy and sell them frequently, trying to time the market. This often leads to worse results than just buying and holding for the long term. Also, while broad market ETFs are great, there are thousands of niche and specialized ETFs out there that can be much riskier and more complex. If you invest in a triple leveraged oil futures ETF, you're not exactly playing it safe anymore, so you have to know what you're buying. Here's a simple real-world example. Let's say you want to invest in the entire US stock market. Instead of researching and buying thousands of individual stocks, you could just buy shares of an ETF like the Vanguard Total Stock Market ETF. Ticker symbol VTI. If you invest $500 into VTI, you instantly become a part owner of over 3,000 different US companies, from the biggest giants like Apple and Microsoft to much smaller companies. It's the ultimate set it and forget it strategy for many long-term investors. Now let's move on to mutual funds, which are sort of the older sibling of ETFs. Like an ETF, a mutual fund pools money from many investors to purchase a diversified portfolio of stocks, bonds, or other assets. The key difference is that mutual funds are typically actively managed. This means there's a professional fund manager or a team of managers who are actively researching, picking, and choosing which investments to buy and sell, with the goal of outperforming the market. The main pro, in theory, is this professional management. You're paying an expert to handle the investment decisions for you. This can be appealing if you don't have the time, knowledge, or desire to manage your own portfolio. They also offer great diversification, just like ETFs, allowing you to spread your risk across a wide range of securities with a single investment. They've been a staple of retirement accounts and investment portfolios for decades for this very reason. However, this professional management comes at a price, and that's the biggest con: high fees. Mutual funds charge an expense ratio to pay for the manager's salary, research team, and marketing, and these fees are almost always significantly higher than what you'd pay for a passively managed ETF or index fund. The dirty secret of the investment world is that the vast majority of these highly paid active managers actually fail to beat the market over the long term, especially after their fees are taken into account. Another drawback is that you can only buy or sell mutual fund shares once per day, after the market closes, at a price called the net asset value, or NAV. You don't have the intraday trading flexibility of an ETF. Some funds also charge loads, which are basically sales commissions that you pay either when you buy, that's a front-end load, or sell, which is a back-end load, the fund, which further eats into your returns. You really have to watch out for these. Let's use a real-world example. The American Funds Growth Fund of America, AGTHX, is one of the largest actively managed mutual funds in the world. An investor might put money into this fund, trusting its managers to pick growth stocks that will outperform the market. While it has had periods of strong performance, its returns are often compared against a simple, low-cost S&P 500 index fund. An investor would need to decide if the potential for outperformance is worth the fund's much higher expense ratio and potential sales charges. This brings us perfectly to our next topic, index funds. An index fund is actually a type of mutual fund, or ETF, but its strategy is so important that it deserves its own chapter. Instead of trying to beat the market, an index fund's goal is simply to match the performance of a specific market index, like the S&P 500. It does this by buying and holding all the stocks or bonds in that particular index. It's a passive strategy, meaning there's no active manager making decisions. The philosophy, championed by legends like John Bogle of Vanguard and Warren Buffett, is that trying to beat the market is a loser's game for most people. Instead of paying high fees for active managers who usually underperform, why not just buy the whole market, accept the average return, and keep your costs as low as humanly possible? This low cost is the single biggest advantage of index funds. Their expense ratios are rock bottom because there's no expensive management team to pay. This passive approach not only saves you money, but also tends to lead to better performance over the long run. By simply matching the market and minimizing fees, index funds have consistently outperformed the majority of their actively managed counterparts. They are also incredibly simple to understand and are tax efficient, as the passive buy and hold strategy results in fewer taxable events compared to active funds that are constantly buying and selling. Are there any cons? The main one is that you will never beat the market. By definition, your return will be the market's average minus a tiny fee. You're giving up the chance to hit a home run by picking the next big stock, but you're also avoiding the risk of striking out completely. If the entire market goes down, your index fund will go down with it. There's no clever manager to try and sidestep the decline. You are fully exposed to market risk. A classic real-world example is the Vanguard 500 Index Fund, VFIAX. This is one of the first and most famous index funds. If you invest in VFIAX, you are buying a small piece of the 500 largest companies in the United States. When you hear on the news that the market is up 10% this year, that's pretty much the return you're going to get. For millions of people, this simple, low-cost, and effective strategy is the absolute best way to build wealth for retirement over the long term. Now for something a bit different, peer-to-peer lending, or P2P. This is a form of investing where you lend money directly to other individuals or small businesses through an online platform, cutting out the traditional bank as a middleman. Platforms like Prosper or Lending Club act as matchmakers, connecting borrowers who need a loan with investors like you, who are willing to fund that loan in exchange for interest payments. The main attraction here is the potential for higher yields. Because you're taking on the risk that a bank normally would, you can often earn much higher interest rates than you'd get from a savings account or even many bonds. We're talking potential returns in the 5 to 10% range, or sometimes even higher. You can also diversify your investment by spreading your money across hundreds of tiny pieces of different loans, known as notes, to reduce the impact if one borrower defaults. However, the big con is credit risk. You are lending to individual people, and sometimes people don't pay their loans back. This is called a default. While the platforms assign risk grades to borrowers, there's always a chance you could lose some or all of your principal on a specific loan. Unlike a savings account, your money is not FDIC insured. This is a real risk you have to be comfortable with. Another downside is liquidity. Your money is tied up for the term of the loan, which is typically 3 to 5 years. While some platforms have a secondary market where you can try to sell your notes to other investors, it's not always guaranteed, and you might have to sell at a discount if you need your cash back in a hurry. It's not as simple as selling a stock. This is an investment you should be prepared to hold for the medium term. As a real-world example, let's say you invest $2,000 on a P2P platform. Instead of funding one big loan, the platform automatically diversifies your money by investing $25 into 80 different loans, with varying risk levels and interest rates. Over the next few years, you receive monthly payments that consist of both principal and interest from these 80 borrowers. Even if one or two of them default and you lose that $50, the interest earned from the other 78 performing loans should more than cover that loss, resulting in a positive overall return. Okay, we can't have an investing video in 2025 without talking about cryptocurrency. This includes digital assets like Bitcoin, Ethereum, and, honestly, thousands of others, often called altcoins. When you invest in crypto, you're not buying a piece of a company or lending money. You're buying a digital token that exists on a decentralized network called a blockchain. The value is driven purely by supply and demand, investor sentiment, and its perceived utility or future potential. The pro that gets all the headlines is the astronomical return potential. We've all heard stories of early Bitcoin investors turning a few $100s into millions. The technology is seen by many as revolutionary, with the potential to disrupt everything from finance to art. This possibility of massive gains in a very short period is what draws many people in. It's the ultimate high-risk, high-reward asset class, but that high-risk part is not a joke. The number one con is extreme volatility. It's not uncommon for cryptocurrencies to swing 20%, 30%, or even more in a single day. The price is highly speculative and can be influenced by a single tweet or regulatory news. There is a very real possibility that you could lose your entire investment. The space is also largely unregulated, which leads to a higher risk of scams, hacks, and fraud. Another factor to consider is the complexity. Understanding the technology behind different crypto projects, the blockchain, smart contracts, tokenomics, can be incredibly difficult. It's a steep learning curve, and investing in something you don't fully understand is a recipe for disaster. Unlike stocks, there are no fundamentals like earnings or revenue to analyze, making valuation extremely challenging. It's more about believing in the long-term vision of the technology. For a real-world example, someone might have bought one Ethereum or ETH for around $2,000. They believe in its potential as the foundation for decentralized finance, or DeFi, and NFTs. The price might soar to $4,000, doubling their money, or it could plummet to $1,000 in a market downturn. A crucial tip here is portfolio allocation. Because of the risk, most financial advisors suggest that if you do invest in crypto, it should only be a very small part of your overall portfolio. Think 1% to 5% at most. It should be money you can truly afford to lose. And let's take a big step back from the Wild West to crypto and talk about the safest place on this list, the High Yield Savings Account, or HISA. In the UK, a similar product is a cash ISA, or individual savings account. These are just like regular savings accounts at a bank, but they pay a significantly higher interest rate. While a traditional brick-and-mortar bank might pay you 0.01%, an online-only HISA can often pay 4%, 5%, or even more, depending on the central bank's interest rates. The biggest pro is safety. Your money in an HISA in the US is typically FDIC insured up to $250,000 per depositor per bank. This means if the bank fails, the government guarantees you'll get your money back. In the UK, the FSCS provides similar protection up to £85,000. There's virtually no risk of losing your principal. It's also completely liquid, meaning you can access your cash whenever you need it without any penalty. The con is the same as with bonds and relatively low returns and inflation risk. While an HISA is a fantastic place to park your cash, It's not really an investment in the growth sense. The interest you earn will likely just keep pace with inflation, or maybe slightly beat it. You're not going to build significant wealth here. The goal of an ISA isn't to make you rich. It's to prevent you from becoming poor by ensuring your cash doesn't lose its purchasing power to inflation. So what's the best use for these accounts? They are the absolute perfect place for your emergency fund, the 3 to 6 months of living expenses you should have set aside for unexpected events like a job loss or medical bill. They're also great for short-term savings goals, like saving for a down payment on a house, a new car, or a wedding that's happening in the next 1 to 3 years. You don't want to put money you'll need soon into the stock market where it could be down 20% right when you need it. As a real-world example, instead of keeping your $15,000 emergency fund in a checking account earning nothing, you move it to an ISA that pays 4.5% interest. At the end of the year, you'll have earned $675 in interest, completely risk-free, just for having your money in the right place. It's a simple, no-brainer move that everyone should make with their cash savings. It's the foundation of a solid financial house. Last but certainly not least, let's talk about investing through retirement accounts like a 401k in the US or a personal pension in the UK. These aren't investments themselves, but rather special types of accounts that hold your investments, like stocks, bonds, and funds, and give you massive tax advantages. They are specifically designed to help you save for the long-term goal of retirement. The pros here are huge. First, tax-deferred or tax-free growth. With a traditional 401k or pension, you contribute pre-tax money, which lowers your taxable income today. Your investments then grow tax-deferred for decades. You only pay taxes when you withdraw the money in retirement. With a Roth 401k or Roth IRA, you contribute after-tax money, but then your investments grow and can be withdrawn completely tax-free in retirement, which is incredibly powerful. The second massive pro is the employer match. If your company offers a 401k match, it is literally free money. A common match is 100% of your contributions up to, say, 3% of your salary. If you're not contributing enough to get the full match, you are turning down a 100% return on your money. This is the single best investment you can possibly make, and it should be your top priority before you invest anywhere else. The main con is the lack of liquidity. This money is locked up for retirement. If you try to withdraw it before a certain age, typically 59.5 in the US, you'll face a steep penalty on top of the income taxes. This is by design, to discourage you from raiding your future self savings, so you should only contribute money you're confident you won't need until retirement. For a real-world example, let's say you earn $60,000 a year and your employer offers a 100% match on contributions up to 5% of your salary. You decide to contribute 5%, which is $3,000 a year. Your employer then adds another $3,000 for free. So you're investing $6,000 a year, but only $3,000 of it is coming out of your pocket. You've instantly doubled your money before it's even had a chance to grow. This is how you turbocharge your retirement savings. And here's a bonus tip for those in the UK or anyone who's self-employed. Look into a self-invested personal pension or SIPP. This gives you much more control and a wider range of investment choices than a standard workplace pension, allowing you to build a portfolio of individual stocks, ETFs, and more, all while still getting the generous tax relief from the government. It's a great option for the more hands-on investor. There you have it. 10 powerful and a couple of bonus ways to invest your money in 2025. As you can see, the options range from the ultra-safe to the extremely speculative, from the hands-off simplicity of an index fund to the hands-on work of being a landlord. There's no one-size-fits-all. Each method has its own potential rewards and risks. What matters most is matching your approach to your goals, your time horizon, and your personal risk tolerance. Don't just chase what's hot, build a plan that lets you sleep at night. If you take away nothing else from this video, remember this. Most financial experts agree on 3 core principles. Diversify, so that one bad investment doesn't sink your whole ship. Think long-term, because true wealth is built over years and decades, not days and weeks. And finally, don't invest what you can't afford to leave alone for a significant period. The market will go up and down, and you need to be able to ride out the waves without being forced to sell at the worst possible time. Did any of these investing ideas surprise you? Which one are you already using, or which will you try next? Let me know down in the comments below. I read every single one. And if you got any value out of this video and you want more deep dives on how to choose the best funds, get started with stocks, or build a retirement plan, do me a huge favor and smash that like button for the YouTube algorithm, hit subscribe, and ring that bell for notifications so you don't miss a thing. Thanks for watching. Here's to building your wealth your way in 2025 and beyond. And as a quick final reminder, investing always involves risk. The value of your investments can go down as well as up, and in some cases, you may get back less than you invest. This video is for informational purposes only and is not financial advice. Seek advice if you're unsure, and never invest money you might need in the near future.